What's going on, guys? Welcome back to another video here. In this one, I'm going to be going over a really fun strategy with you guys that could have 1,500% returns, 5,000, or even 10,000% returns if you can catch the right one. Now, I know that title is a little bit crazy, and some of you guys might be thinking, how could you possibly be getting these types of returns on these trades in the market? But we're going to go over exactly how you can do this. So, without further ado, if you guys do enjoy videos like this, make sure you guys drop a like down below, comment if you have any questions, and subscribe for more videos like this. But let's get into it over here. So, the 1,500% return strategy. Now, first, as always, I want to go through a couple of expectations with you guys. Oh, and also, if you guys want access to the strategies that I trade every single day, a watch list of stocks that are about to explode before they do, 3 private live streams a week, some of the most powerful trading strategies in the game with hours and hours of educational videos for you, make sure you guys check out that waitlist link down below. It is waitlisted because I tell all of you guys that all of you get my complete undivided attention. You have full access to me when you guys hop in, and I want to make sure that you guys fully understand these strategies, the really, really powerful ones that I use every single day, because of how powerful they actually are. So if you are interested in that, the waitlist is down below, but let's get into it here and go over a couple of expectations. So, first one here, a lot of you guys are going to see this strategy when we start talking about it, and you're going to want to trade it too much, and you're probably going to trade it incorrectly. Now, the most common way that people start trading this type of strategy incorrectly is that they're sizing too big. Think about it like this. If a trade has the potential to generate you 1,500% if it ends up working out, well, you really, really do not need to be risking any more really than half to 1% of your account on the total trade at any given time. And I'm going to show you guys some math with this as well. Now, again, this strategy is definitely one that you want to understand how to use. It's a really nice addition to everybody's trading toolbox, but with more potential for reward is always going to come more risk. I do not want you guys to think that just because this has the potential to generate these crazy returns, that it is going to have a very, very high win rate. That is not the case in these examples here. But if you can balance it out over time, any of the winners that you're going to have are going to wildly overtake any of the small losses on some of these trades that are naturally going to happen through the normal course of trading. So what does this actually kind of revolve around? Well, it's going to be revolving around trading earnings. Now, what you will see most people on Twitter, social media as a whole, Instagram, TikTok, what most people will do is one of two things. They'll either just take a one-directional or one-sided bet on a company's earnings. If it hits, they'll tell you, and they'll try to make it look like they're the best trader in the world. If it doesn't, they won't tell you. Or what they'll do is say, oh, I'm going to play a strangle or both sides of it, which we're going to do in this example here. But then they won't tell you the other side of it. But most people are not using math and statistics the way that I do in order to give ourselves an edge in the market, which is always what we need to have when we are approaching the market from any point of view. Whether you're trading with my strategies, some other strategies out there, doesn't matter what it is, you need to have an edge. You need to know exactly why your edge works and how it performs over time. So again, right here, we use statistics and mathematics to give us an edge in the market where all we have to decide, and you guys are going to see this, is whether or not the market has a high probability of mispricing a binary event where something's either going to go up significantly or down significantly, or it ends up doing nothing. Or in other words, do we think that the market makers are right or wrong / are willing to take too much risk on any given earnings report? So, moving on to the next step here, well, let's actually go through how we're going to be starting to set up this trade and what we need to understand about this going forward. So, in order to figure out if the market is going to be correct or incorrect, according to the market expectations, well, we need to find out exactly what those expectations are. So here's how we do this. It's very, very, very simple. Now, some of your brokers out there, I believe TD Ameritrade's Thinkorswim actually does this calculation for you in a slightly different way. But again, it doesn't have to be exact for a very specific reason that we're going to cover in a minute. So on the day that the company is going to be reporting their earnings, we'll be doing the following calculation. We're going to add the at-the-money strikes, the call and put for the same expiration date, that week's expiration. So let's say a stock is reporting their earnings on Wednesday. Well, we would be doing this calculation on the expiration that is happening that Friday. And then once we have that number, we add the at-the-money strikes. We then divide by the current trading price. So that might seem a little bit confusing. So let's go through an example. So this is an example of Apple's options chain going into this week here. So when we do these calculations, guys, you're not going to have a stock that's trading exactly at 195 or exactly at 197.5. It's a rough estimation, and that's all you really need to do in order to figure out what the market is expecting. So what we then need to do is say, okay, where is price trading closest to? Is it trading closest to 195 if it's trading at 196.89? Or 197.5. Well, it's trading closer to 197.5, so we're going to be using this strike. So we're going to add 305 to 345, and what do we get? So right here, we add that 305 to the 345, and it gives us a total of $6.50 of total premium. So dividing by that current trading price, we would then see that the market is expecting Apple to move up or down 3.3% from the time now until expiration on Friday. That is a very, very important concept there, guys. That is what the overall market is expecting. Now, going back to what I said previously as to, okay, we need to figure out what the market is expecting and whether or not we think the market is correct or incorrect, or if the market makers are willing to take on too much risk for a significant event. Now, when we move on to the next slide here, this 3.3% number is obviously very important because if Apple were to be reporting earnings this week, they're not. This is just an example. That's the percentage move, obviously, that the market makers are going to be hedging for. Meaning that if Apple were to move 3.3% or less from now till expiration, the market makers will make a significant amount of money. They'll be making essentially their max gain on all the contracts that they're selling across the board, even with all of the hedging that they need to do in order to be a market maker. So even though this is not technically, this next concept here, what the market makers are doing, I like to think of this as a form of a normal distribution curve where the market makers are hedging for about a 1 standard deviation move. So now what does that look like? So when we come to this slide here, this is a picture of a normal distribution curve. I don't want to lose you guys here. This is important for where we're going to be buying our strikes. But when we take a look at that 3% number, let's just imagine that this 1150 number right here is the current trading price of Apple. And on each side here is 3.3%, where the market makers are hedging for and are probably going to make the most amount of money. This 68% area here is effectively saying that 68% of the time, all of the possible outcomes are going to fall within this range. Now, again, if that's going to be the case and that's what's going to happen after the company reports their earnings, well, your strangle, which we're going to be talking about in a second, is probably not going to be profitable. So if the stock starts moving out into these areas that you see here after the company reports their earnings, that is where the money is made. So think about that right here. This area in between is that 3.3% down, 3.3% up. And these areas, in addition, are going to be 2 standard deviations, so this is going to be about 6.6%, and 3 standard deviations is going to be about 9.9%. All right. So now how are we actually going to be taking advantage of this move? Well, I've used the word, that key buzzword there, the options strategy, a strangle. So let's go through exactly what this is very simply before we go through some live examples on some of the earnings trades that I had mapped out for people very recently. So a strangle is an option strategy which requires buying options contracts for the same expiration date but with different strike prices. So let's think about that 3.3% example again. If we were to do a strangle at, let's just call it 1 standard deviation, that 3.3% to the downside and the upside, that's exactly where we're going to be buying our strikes. For this earning strategy, I like to buy my strikes 1.5 to 2 times what that market expectation is so that we're able to kind of operate in this area down here. Now, remember at the beginning of the video where I said, 1,500% with more potential gain is always going to come more risk. Well, if 95% of the time or 68% of the time we're going to fall within this area, well, only about 32% of the time would we expect, let's just say, a stock to trade outside of that range. Now, remember, it's not perfect. This is not what the market makers are actually doing, but this is kind of how I like to visualize this and think about these types of trades here, just from a conceptual perspective. So moving on. So this is a defined risk strategy. When you trade a strangle, a long strangle, where you're buying these contracts, the max loss is the amount of money that you put into the trade. So when we were thinking before, when I said, well, you only really want to be putting 0.5% to 1% total risk, and that's going to be your total position. Well, that means that you would only ever be putting in half of a percent of your account to the downside and 0.5% of your account to the upside. Now, let's think about it like this. If the total trade, so that 1% on both sides, is going to return 1,500%, well, you're still up 15% on your total account from one trade, a 1 to 15 risk to reward. That is absolutely nuts. So remember, we ran that calculation. Well, we buy our options contracts at what the market is expecting, and the stock has to still make a massive move to overcome the additional baked in implied volatility going into an earnings event. Think about it like this. If a company has a giant event coming up, well, obviously, it has a higher potential for it to move significantly depending on what type of news is released. Well, that's going to inflate options prices, and that's what we're looking for when we're running that calculation, because we get to this most important part here. So for those of you guys that made it this far in the video, good for you. This is the most important part, so please pay attention. If you don't understand every single step of this, there's a high likelihood that it could not go in your favor, even if you are correct. If the initial calculation, so that 3.3% that we were talking about with Apple, yields a percentage move of above 6.5 to 7%, I will never take the trade. Here's why. If I need to be buying my strikes 1.5 or 2 times that expected move, well, then something crazy has to happen on a company's earnings in order for it to move that significantly. Now, I know the volatility on a lot of these earnings reports recently have been quite significant, but you still want to be making sure that you're putting yourself in the best position for success and having an edge in the market. Even if you're right around that 6.5 area, that's a little high, but we're actually going to go over one that is about 6.5%. Now, the other thing that we need to be thinking about here, we only will be trading on well-known companies with liquid option chains. So if there's a company that comes up that's reporting earnings and you decide, oh, I'm going to take a look at this and price it in, and the spreads are wide on the option chain and you really haven't heard of the company before, probably doesn't make a whole lot of sense to trade that. So couple more tips before we get into this actual example here. Risk management, I can never harp on this enough with you guys. You are never to trade these events with more than 1% of your account total, not each side, total. So 0.5% each side. These trades, guys, like I said before, it's a great thing to add to your toolbox, but it is not something you want to be making the core of your overall strategy. These trades, you should expect to lose most of them, but on those that end up having those significant gains, we're able to risk 1% on your account and potentially make 10, 15, 20, 30% or more if some of these end up playing out like we're going to show you they absolutely can. And you always also want to be performing that calculation, adding the at-the-money strikes and dividing it by the current trading price in that last hour of trading before the company reports their earnings. Because, again, as you get closer to the end of trading for that day, well, there's going to be last minute positioning, buying and selling of options. Some of the prices are going to move around a little bit, and you want to make sure that the pricing of those options and what the overall market is expecting is still what you thought it was either the day prior or the morning of that earnings report. Now, let's actually take a look at an example here, guys. So Salesforce recently reported their earnings, and I probably spent about an hour and a half in one of the groups that I'm in with some money managers and some very successful market participants, kind of explaining how I go about earnings, and we were going over Salesforce here. So Salesforce was pricing in 6.5% for their earnings. When you hear me say pricing in, think about that 3.3% number that we got from Apple, adding those at the money strikes and dividing it by the current trading price. So when I say pricing in, that was what that calculation was yielding for Salesforce. Now, I'm going to give you a little tip here at the end, but since Salesforce was pricing in 6.5%, I was completely fine with taking this trade if this other factor wasn't present, which we're going to cover in a second. So what we were looking at was the 290, where was it trading? Yeah, so the 295 strikes, which were right up here, and then also the 245s, which were right down in here. So what happened with Salesforce is it doesn't look all that significant on the chart, but it is. When we see this price drop here to open, it is down 16.44%, or about $44. Now those puts ended up actually running about 3,500%. So I actually could have put in the title, 1750% option strategy. But again, kind of with the spreads and what was happening there, you probably would have gotten out for about 3,000% on the put side. So if you risked 0.5% on the put side and made, let's say, about 3,000% on this drop here with earnings, and then you had the call side, which is going to expire worthless. The call side of this, guys, of the strangle that we were talking about, is going to go absolutely to zero. But if the put side is going up 3,000%, that is perfectly fine because the total return on that trade was about 1,500%. That is absolutely phenomenal. So let's go over kind of why I didn't take this trade. Now, I haven't been trading a whole lot of earnings recently just because of kind of the strategies that I teach you guys all the time. I mean, they're so powerful, finding stocks that are about to explode before they do. I've been focusing a lot in on that and the day trading mastery course strategy, the 16, 17 winning months in a row. That thing has been absolutely really awesome for us. But what was happening was that the options on the call side for Salesforce were a lot more expensive at that 10 to 12% area out of the money than the puts were, which showed me that there was a big mispricing in the options chain, which I didn't really want to be a part of. Now, the trade still worked out very well, and I wanted to give you guys a little bit of a tip if you're actually going to be in that situation where those call contracts are going to be way more expensive than the puts. So what one of the people that I talk to all the time actually did was say, well, we could actually just go for a 1-to-3 ratio of how many calls and puts we're buying, put the same dollar amount on each side to still have that 0.5% risk on each side and still be okay, but have a little bit more put contracts to the downside. Now, in this case, that ended up paying off very, very well because more put contracts going up a higher amount ends up making you a very, very significant amount of money on this drop to the downside. So guys, that is effectively going to wrap up this video here on this strategy. If you did enjoy it or you want to see more strategy videos like this, make sure you drop a like on this video or comment down below a strategy that you have or a strategy that you guys want to see me test next. I've got a video coming out on Thursday that I think is going to be really cool for you guys. This is one that you might be able to use every single day. So other than that, guys, I'll see you guys in the next one. Peace.